Hey everyone, welcome back to another episode. In this video, we'll dive deep into our Heiken Ashi trading strategy and explore how we integrate it with price action. Heiken Ashi candlesticks are incredibly useful because they smooth out price action, reducing the noise typically seen in traditional Japanese candlestick charts. This smoothing effect simplifies the decision-making process for trade entries and exits. If you want more frequent videos, please hit the like button, subscribe, and turn on notifications. Let's get started. Before we dive in, it's crucial to note that everything discussed in this video is applicable to currency trading, stock trading, and crypto. Price action tends to remain relatively consistent across different assets. So we'll delve deeply into this topic in the video. Are you feeling confused about not knowing exactly how or when to enter a trade? With so many different candlestick patterns, traders can become paralyzed by overanalysis, trying to determine whether a particular candlestick is a valid entry signal or not. Have you ever found yourself in a trade where the market was moving in your favor? It's frustrating when you exit a position too early and then watch the trade move further in the direction you anticipated. As traders, we have many factors to analyze simultaneously. If you spend too much time deciding whether to enter a trade due to complicated entry rules, you might miss opportunities. Exiting a position prematurely can also impact your long-term profitability. But what if there was a simple way to know exactly when to enter and exit trades without complex analysis? That's where the Heiken Ashi bars come in. In this video, I'll share a simple Heiken Ashi strategy to streamline your entries and exits, ensuring you know precisely when to enter or exit a trade. And now, what is the Heiken Ashi technique? The Heiken Ashi technique is a Japanese candlestick-based technical trading tool that utilizes candlestick charts to represent and visualize market price data. It's employed to identify market trend signals and forecast price movements. This method utilizes average price data to filter out market noise, resulting in a clearer illustration of market trends and direction, facilitating the determination of potential price movements. This trading technique helps traders identify when to hold onto a trade, pause a trade, or recognize if a reversal is imminent. The Heiken Ashi trading technique was developed by Munehisa Hama in the 1700s. The technique shares some characteristics with traditional candlestick charts used in trading, but differs in how the values for candlesticks are computed. In Japan, the word Heikin means average or balance, and Ashi means bar or foot. Hence, Heiken Ashi means average bar, resonating with the trading technique which uses the average price of the security. The main difference between the traditional candlestick chart and the Heiken Ashi chart is that the latter uses a modified formula based on two-period moving averages instead of open high, low, and close prices. This modification results in a smoother chart, making it easier to spot trends and reversals. Additionally, Heiken Ashi charts obscure gaps in some price data. Comparing the left chart, which uses traditional candlestick bars, to the right chart, which uses Heiken Ashi bars, you can observe that the Heiken Ashi bars are much smoother. This is why some traders prefer to use Heiken Ashi candles, since it reduces noise on the chart and allows for clearer trend analysis. What sets Heiken Ashi apart from a traditional Japanese candlestick chart is how the price is displayed in terms of the open and the close. If you examine the Heiken Ashi chart closely, you'll notice that each Heiken Ashi candlestick starts from the middle of the candlestick before it, rather than from the level where the previous candlestick had closed. Heiken Ashi candlesticks behave this way due to the method by which they are calculated. If you're interested, here's the calculation for Heiken Ashi. Close it equals the average of open, high, low, and close. Heiken Ashi open equals the midpoint of the previous Heiken Ashi bar. Heiken Ashi high equals the highest of high, close, and open. Heiken Ashi low equals the lowest of low, close, and open. By the way, there's no need to memorize this formula or try to understand why it's calculated this way. It won't necessarily make you more profitable or profitable at all. Just understand that it's designed to help you identify trends better in the market. Also, don't mistake Heiken Ashi bars as a trading system because they're not. If you go long whenever you see a bullish bar or short whenever you see a bearish bar, you'll likely go broke very quickly. Heiken Ashi bars simply provide information about the market. With Heiken Ashi bars, price action patterns are simplified compared to traditional candlestick bars. While traditional candlestick bars offer a wide range of patterns such as doji, gravestone doji, dragonfly doji, pin bars, engulfing candlesticks, and more, Heiken Ashi bars categorize price action patterns into just 3 main types. First, bullish Heiken Ashi bars. These bars have only a wick at the top with no wick at the bottom. As long as it's an up bar with no wick at the bottom, we consider it a bullish signal. Second, bearish Heiken Ashi bars. These bars have a wick at the bottom but no wick at the top. As long as it's a down bar with no wick at the top, we consider it a bearish signal. Third, indecision Heiken Ashi bars. To simplify Heiken Ashi bars, all bars with wicks at both the top and bottom are categorized as indecision bars. Regardless of whether the bar color is bullish or bearish, if there are wicks on both sides, we consider it an indecision Heiken Ashi bar. Now that you understand what Heiken Ashi bars are and are familiar with the 3 different types of Heiken Ashi price action patterns, you might be wondering why we use Heiken Ashi bars for our trading. The answer is simple because they help simplify trade entry and exit decisions. When it comes to entering a trade using Heiken Ashi bars, it's important to resist the urge to simply go long whenever you see a bullish Heiken Ashi bar, or go short whenever you see a bearish Heiken Ashi bar. While some may advocate for this approach, it's not advisable. To have an edge in trading the markets, you need to establish specific criteria that must be met before entering a trade. Simply relying on the appearance of bullish or bearish Heiken Ashi bars is not sufficient for making informed trading decisions. Applying rules or criteria for entering a long position. The higher time frame must be in an uptrend. This means that on the higher time frame, the market should be making higher highs and higher lows. For example, if you're trading the 1-hour chart, the higher time frame would be the 4-hour chart. If you're trading the 4-hour chart, then the higher time frame would be the daily chart. It's preferable to avoid trading time frames lower than the 1-hour chart. Lower time frames not only require constant monitoring, but the commissions and spreads can significantly erode your edge. While trading lower time frames can be profitable, it's more challenging due to the larger percentage of your trade parameters consumed by spreads and commissions compared to higher time frames. Criteria number 2, the 10 exponential moving average is above the 30 exponential moving average. I utilize the 10 EMA and 30 EMA to assess the momentum of the trend. Criteria number 3, the time frame you're trading on must satisfy both criteria 1 and 2. Once these 3 criteria are met, I will consider entering a long position when the price bounces off either of the exponential moving averages, and the first bullish Heiken Ashi bar is formed at a higher low. In this case, I would place a stop loss below the low of the current swing low. Criteria for a short trade. 1. The higher time frame must be in a downtrend, indicated by price forming lower highs and lower lows. Criteria number 2, the 10 exponential moving average is below the 30 exponential moving average. This should be easily identifiable on your chart by now. Criteria number 3, the time frame you're trading on must satisfy both criteria 1 and 2 as well. Once all 3 criteria are met, I will consider entering a short position when the price bounces off either of the exponential moving averages and the first bearish Heiken Ashi bar is formed at a lower high. How to exit a trade using Heiken Ashi bars. Since this is a trend trading strategy, we aim to exit only when the price forms an opposite Heiken Ashi bar. For long trades, we exit when a bearish Heiken Ashi bar is formed, and for short trades, we exit when a bullish Heiken Ashi bar is formed. As you can see, it becomes much simpler to determine when to exit. Sometimes you might get faked out of your position in a long trade by a bearish Heiken Ashi bar, only to see the next bar become a bullish Heiken Ashi bar, or vice versa in a short trade. But that's fine. There's no way you're going to catch every single bit of every trend there is. Ultimately, if you are profitable from your trades as a whole over a series of trades, then that's all that matters. All right, enough theory. Here's a trade example to show you exactly how to enter and exit a short trade. In this chart, you can see that the market formed a lower high and bounced off the 30 exponential moving average. Once you see that happen, the next step is to wait for a bearish Heiken Ashi bar to form. When it's formed, go short at the close of the bar. From there, the market dropped pretty quickly and indecision Heiken Ashi bars started to form. This is not a good reason to get out because it could just be consolidating before the price goes down again. However, in this case, the price did not go down further. Instead, a bullish Heiken Ashi bar was formed, and that means to get out of the trade at the close of the bar. Here's a trade example of how to get into a long trade. In this chart, you can see on the left-hand side that the price has spiked up pretty quickly and then started consolidating. Consolidation in an uptrend is a good sign because this could mean that price can go up further. The market did bounce off the 10 exponential moving average and formed the first bullish Heiken Ashi bar. Go long at the close of the bar. Price did go up further before an indecision Heiken Ashi bar is formed. Immediately after the first indecision Heiken Ashi bar is formed, the next bar after that is a bearish Heiken Ashi bar. That's the signal to exit out of the trade. However, not all trades are going to be like this. As I've said this a number of times already, it doesn't matter if you do not catch the whole movement of the trend. It's impossible to do so. What you can only do is take whatever you can based on your trading system, and in the long run, that will lead you to profitability. Heiken Ashi bars are great because they smooth the price action. As a result, much of the noise shown in traditional Japanese candlesticks is eliminated with Heiken Ashi charting, making trade entry and exit decisions simpler. As always, if you learned something new or if you want more videos more often, make sure you subscribe, click the notification bell, and leave us a like to show your support. See you next time.